All right, well, good morning, everyone. Thomas Montgomery. It's good to be with you today. Today is Monday, July 28th, 2025. We get together most weekday mornings at 8 o'clock Central, talk about strategies, tips, techniques, share success stories, and support each of you. Our primary topic today is on private credit. So we're going to spend most of our time on it, and I have an information sheet here we'll use for talking points. But before that, I want to give you a quick update on the outsourced business development program. So we announced it, I guess, about a week ago. It was designed to be a completely hands-off, outsourced approach. So those of you that either don't have the skill set, the dedication, the time, the ability, the willingness, whatever the situation may be, to get the word out about the Shelf Corps, that we would do it for you. And so essentially, we put together the ads, we place the ads, we pay for the ads, we get the leads, we close the leads, and then we pay you. And so that's a very abbreviated explanation, but it's completely outsourced. So we've had a number of you enroll, and so we're in the process of getting everyone's ads put together. But I wanted to mention Troy quickly. Troy's one of our resellers. Let's see if Troy's on live this morning. He is. Welcome, Troy. So, Troy, you are probably aware of this. We ran his report. So, in his first 48 hours of being in the OBD program, which means we were running ads on Meta, Instagram, other places, in the first 2 days, first 48 hours, he had 42 responses. So, that's not bad, right? Around 20 a day, 21 a day to be exact. Not bad, because you and I know there's a lot of people that want money to start or grow a business. We also know there's lots of banks and credit unions, but most people, they don't have a fundable business. So it's not an issue that there's not enough money out there. It's a problem that they don't have a fundable business. That's what you and I fix. So 21 ads per day, not bad, right? And we normally average around 10, so that's actually twice as good as normal. But let's look at how many closes he had. And when we say closes, we mean enrollments. How many people signed his contract and committed to pay Troy? 32. This man had 32 enrollments in his first 2 days of the OBD. Now, you all are great, and we've got some big hitters. We got Selena and Pauline and Mark and Stephanie and Toby. I know a lot of you produce big numbers, but the truth is, some of you, you haven't produced 32 all month long. So you look at the month of July, some of you haven't produced as many in the month of July as Troy did over the weekend. Now, how much will Troy make from that? We know he'll make at least 5,000 a deal, right? Because each client that's using the Shelf Corps guaranteed a minimum of 100,000. They promise to pay a 10% performance fee. Troy or you, whomever is the referral source, gets half of that. So you're making at least 5,000 a piece. So over the weekend, Troy made 32 times 5,000. Troy made over 150,000 this weekend without lifting a finger. Now he did fund the ad spend, right? He did pay the 1,000 for the ad spend. So I'm curious, did any of you make 150,000 over the weekend? We have 636 of you on, so I'm just curious. Let's take Jeff, Mr. Walter. Did you make more or less than 150,000 over the weekend? Drake, how about yourself? Debbie, I know you're up and coming. Debbie, did you reach over 150,000? I don't think many of us did, but Troy did. So the OBD is great. So it's essentially you funding the ad spend. We do all the work and you get the results. So just wanted to share that with you in case you had any questions, comments, concerns. We do have a few more enrollment slots. There's no contract to sign. All you do is you fund the ad spend and we do the rest. All right, so with that being said, let's go ahead and get to our topic today, which is on private credit. So the title here is Forget the Banks, There's a Better Option for Business Funding. As a reseller or as a branch office, those are two different distribution models. I don't want you leading with, here's where the client will get funding. Because when we take a client through the process, we'll determine, based upon their wants, their needs, their mitigating circumstances, where the right source of funding might come from. Maybe it's an SBA loan, maybe it's not. Maybe it's a line of credit, maybe it's not, maybe it's private credit. So when I share this with you, this is true and factual and hopefully motivating, but it's not what you're going to lead with. Don't focus on where the client's funding source will be, because frankly, I don't think that you'll know up front. And it's not really about the client's preconceived preference. They're always in control. It's about us going through a specific formula to determine what the right type of funding is for them. So, with that being said, let's go ahead and talk about private credit. Now, some of you may be familiar with this, some of you may not, but it's worth us going through because it's a great arrow in our quiver that I don't know that we brought enough attention to. So, private credit is a rapidly growing segment that functions as an alternative to traditional banks. Private credit can provide borrowers with a higher degree of financial flexibility and more customizable loan terms and repayment schedules. So, in short, it's not going through a bank. Because when you get an SBA loan, the SBA is not the lender, they're the guarantor, it's still going through a bank. So we're going outside of the banking system into the private credit world. Some of you think, oh, that's hard money loans. No, that's not what we're talking about. So private credit, private credit. So with that being said, there are different types of business funding available through private credit. The bottom line is they are non-bank lenders. They have the money and they have the money to spend to loan, and it can be deployed more quickly with looser underwriting than what traditional banks. Banks are highly regulated. I knew that we needed to have this discussion because it was last week we were kind of hinting towards private credit. And we even talked about the recent article in the Wall Street Journal where some of the banks are developing their own subdivisions of private credit that's outside the bank. Why would they do that? Because banks are highly regulated. But private credit isn't highly regulated, so they can frankly fund deals that banks wouldn't. Continuing on. So, unlike normal bank loans, there are multiple types of debt available from private credit lenders. So, let's look at the four main categories that's in our world. There's other models, but let's focus primarily on what would be impactful to what you and I do. So, first of all, yes, there's funding for startups, and that's typically under the category of venture debt. Secondly, distressed debt, and this is very much needed for some of our clients where some of them are in a difficult position. On paper, they look distressed, they look like they're in trouble, but private credit will fund distressed companies, subject to their desired due to their preferences. Asset-based lending, and this is something that I think a lot of you are missing out on. We provide for free AR, accounts receivables, to every one of the participants through the grant. So we give them AR, and then if they ever want more, they can get more. But AR is a type of an asset that, of course, can be collected upon, not our discussion today, what we call liquidation, but also it can be lent against. Now, typical banks aren't normally going to do a loan just based upon AR because it's a little too risky. What if the money's not collected or not collected in time? but that's where private credit lenders come into play. So that's another option. So let's give an example of this just to make it a little bit more clear. We've got Mr. Johnson on today, Darius. He's one of our big hitters. So let's say that Mr. Johnson wants $1 million. Just pick a round number. So we can transfer to him legally and ethically $1 million of accounts receivables within 24 hours. There's a real bill of sale. It's really transferred to him. It's really his. So now he has on his balance sheet $1 million. Is that enough alone to go to a bank to qualify for funding? No, because banks are going to look at other things, other elements, other underwriting criteria. However, there are some private credit lenders that will loan just upon the AR. So if you know someone that's looking for funding fast with less strings attached, if you will, we may want to consider transferring them a nice block of AR, get that to them, and then be able to use that for funding. And then the fourth category are real estate projects. Real estate projects are unique in the sense that often a lot of money needs to be spent before we can start generating money. And so let's say we're going to build an apartment complex or even buy an apartment complex, like I was talking to Mr. Harris about earlier this morning. Well, all that money has to be spent up front. It's not like we can kind of ease into it until we buy and secure ownership of that real estate, then we can't start earning rental income. So this is another example that can be considered higher risk, which might be tough to get funding through a bank, but through our private credit lenders, this is something that they love to do. So, why does private credit appeal to companies needing capital? More flexible terms, easier access, faster funding, and as we've alluded to, fewer disclosures and oversight. Because again, sometimes when banks say no, it's not that they don't think that it's a good deal, but the structure might just present on paper too much risk for them to be able to meet the oversight requirements they have. That's where the private credit can be great. Now, I see that DeAndre's asking a question, and DeAndre's right. In some cases, the interest rates can be higher with private credit than through traditional financing. That could be true. Until we run the deal and get the term sheet, we don't know. However, in many cases, it's not where does the best interest rate come from, it's where can we get the funding. So if we have an option of one, private credit, if there's no banks that'll pick it up, it's really a decision of do we want to fund this project or walk away from it. So private credit is a great safety net for what you could consider higher risk deals, those that we need more flexible terms. Frequently, and who was it that brought me that deal last week? I think it was Lamy. And one of Lamy's clients just got funded over the weekend. He's pretty excited getting a big check from us. But one of Lamy's clients wanted, if I recall, no payments for the first 90 days, first 3 months or 6 months. So that's where we can see more flexible terms with private credit than we can traditional lenders. All right, so what are the steps to getting private credit? Well, first we need the documentation set. So this is true, whether it be getting an SBA loan, a non-SBA bank loan, any type of finance, and we need to put together the loan package, the document set. And so that includes things such as the business plan. The business plan with the Shelf Corp we provide, it's ready to go. If we need to edit it for the client's preferences, we can. But the business plan, of course, tells the lender what the business does and what they sell, the goods or services, what's their marketing plan, also has the associated financial projections. So that document set is important, and we provide that. So we actually provide with the Shelf Corp a business plan ready to go. We provide a use of funds ready to go. We provide the financial projections ready to go. So the shelf corps come with all three of these ready to go. Now, if the client wants us to make changes or edits, we can, but those boxes are checked within 7 days of the client getting the shelf corp from you. The other element that private credit lenders are concerned about is a collateral statement. So, in other words, what does the borrower have to pledge to qualify for the loan, whereby if the loan were not repaid, that the lender, the private credit lender, could mitigate the risk. And in most cases, we're leveraging AR. Accounts receivables, if you're not familiar with it, I think it warrants more consideration because AR is the one type of asset that we can get for pennies on the dollar, turn that into collateral for these large loans, and then turn around and liquidate it and turn it into cash. And we'll have some more detailed discussions on that in the near future. But the document set that we most specifically need here, what you'll like, I think, about private credit lenders is they're much less worried about credit worthiness. They're worried about, instead of credit, they're worried about what is this project? How much money will it make in the future? They're much more forward looking rather than backwards of saying, well, how did the business owner or business pay their bills in the past? So, number one step is we need to prepare documentation, but frankly, that's what we do, and we do that through the shelf corp. Then, secondly, we need to find the right private credit firm. There are lots of them. There are 7 that are very large, that are the biggest hitters in the marketplace. And some of them have up to literally 1 trillion in assets, not a million, not a billion, but a trillion. So there are 7 really big hitters that we could take any of these deals to. And then there's lots of smaller ones. So based upon the deal, we'll match it up to the right source of capital, in this case, the right private credit firm. The third step is then we need to negotiate the deal because we shouldn't have a problem getting offers from the private credit lenders. However, we need to make sure that the client's satisfied so then we can negotiate what the deal is and what the repayment terms. So, for instance, if we don't want payments for the first 90 days or first 180 days, 6 months, do we want interest only payments for the first year? Do we want a balloon after 5 years so there's lower payments initially? We can work with you and help negotiate those terms. Once that's been negotiated and agreed to, then the documents are signed and the funds are received. So this process is typically half the time or less of going, well, this is all taken care of for you, but as far as going through, I guess, these 3 steps, typically half the time or even less than going through traditional bank lenders. So it's faster. But as was mentioned earlier, might the cost of capital be a little bit higher? Yeah, it certainly could be. But with that being said, if we are prioritizing speed, then can't beat this. And then secondly, if we can't get a regular bank to fund the deal, then this may be our only option. But of course, the client would always have the option to say no. If they don't like the deal, they might say no and just walk away from it. So the bottom line is, as a 501c3 nonprofit, we've received a grant. We provide free shelf corps to participants, and then we turn around and use those shelf corps to be able to get funding. So we provide the entity, we help them build their loan package, which frankly comes with the entity, but we can make modifications as needed. And then we guarantee the capital raise that's in writing. So our website's 509pacific.org. I think you're familiar with that. Our support line's 903-347-8042. With that being said, let's go ahead and get into the questions, comments, concerns any of you have. So let me read through these. And Selena brings up a good point. So this is not about selling the prospective client on specifically which lender will fund their deal. We don't know that. We can't know that up front. So we have a process. We're going to provide them a fundable business. It goes down to the bottom. We're going to provide them a fundable business with the shelf corp. We're going to help them build out their loan package, and then we're going to work with them to go get that funding. But yeah, you don't want to go promise people, oh, you're going to definitely get a private credit loan. Maybe they're well suited for an SBA loan. Maybe they're well suited for just a general bank loan. So it's not your role to match the client to the right lender. The system will take care of that. But certainly this is important, especially when you have clients that are looking for much larger capital raises. We have Brandon. Let's see if Brandon's on. He's in California, so he's usually not on this early. Let me see if Brandon's on. He's not. We're working on $1 billion capital raise. So not a million, a billion. We're going to have to run it through private credit. We don't have any of our lenders that are willing to underwrite the deal that he's bringing for $1 billion. But we absolutely do have private credit lenders. So for much larger deals, this may be where we need to go. Darius asks, will there be a cost for the $1 million capital raise? So that's a good question. Sure. So what is the cost? And we can bring up our notes screen. So let's bring up a new topic, and he's opened up a good can of worms. Cost of capital. So what are the different elements of the cost of capital? So there's going to be the repayment of the principal amount. In other words, the amount borrowed. In his example, it was 1 million. Yeah. So to no surprise, it's not a gift. It's not Christmas. The lender is going to want their $1 million back. Of course, not being sarcastic to him, but yeah, of course, we're going to have that. And then also there's typically going to be interest costs in there. Yeah. So lenders loan money with the hope of being repaid, and then they also want to earn money on that transaction, and that's in the form of interest cost. We don't know what the interest cost will be until we get a term sheet from the lender. If there's no term sheet, there is no interest cost. Clients don't have to accept any deals they don't want, but yes, there will be 10 out of 10 times a principal amount repayment. I think 10 out of 10 times there's going to be interest cost. And then there could be what we call other cost of capital. In other words, what did it take us to get to that point? Well, in our model, because of the grant, we're giving away the shelf corps, but there is a processing fee. You all are determining that. There can be some incidental cost of getting the shelf corp set up. So that's true. Like having QuickBooks is very helpful to be able to produce the financials, like the collateral statement. So what does QuickBooks cost? Is it $19 a month or something like that? So there can be other cost of getting the business ready for capital. And then there is the performance fee. So with the performance fee, we don't charge the client in advance. We're paid based upon the capital raise. And then, of course, that's where the 5% to you comes from. Because if we didn't charge a performance fee, you wouldn't be paid anything on the back end. So that is important to consider. And then I think Darius's other question was regarding collateral. So let's go back to that. So we were talking about asset-based lending and accounts receivables. So, and the importance of collateral here in 1D. So I guess we'll go ahead and add that in. I think that was the core of his question. We don't know up front if a client has enough collateral or not. We know that we're going to give them some, it's part of the deal for free, and then they have whatever collateral they bring to the table. But Mr. Johnson's point's accurate. There could be collateral acquisition costs if applicable. So in other words, the client doesn't have enough collateral to qualify, then we can provide that collateral for them and we can get financing for that so they don't have to pay out of pocket. But Mr. Johnson's correct. And that kind of falls underneath other cost of capital. But a lot of these clients, they have enough collateral themselves. They don't need to supplement. But it's a good point to consider if we're going to pursue funding that's less about credit, less about historical cash flow, it's more collateral based, then we do need to make sure we have collateral. All right, Stefan asked a good question about first tranche. So let's break that down. So there are typically two tranches of capital raised. There's the first tranche, and that's when the client first comes in. This is normally offers on we'll say day 7, and funded typically by day 10. So this is what clients get up front. Once we've delivered the shelf corp in 7 days, we're able to get them first tranche offers, just like Lamy's client got over the weekend, or we found out about over the weekend. And so first tranche would not be well suited to private credit. It would also not be well suited to an SBA or a full bank loan, because we need to build the loan package out, this documentation, and we do that once the client is in phase 2, once they have enrolled in the second phase. So we want to be clear on this. So there's the first tranche and second tranche. No, and this is the answer to Stefan's question. No, we wouldn't use private credit for the first tranche, but yes, we could absolutely use it for the second tranche, the large. All right, great question there. Troy, again, congratulations, Troy, on your amazing freaking weekend. But his question is, can you get a private credit loan and then pay off later with more traditional loans? Sure, yeah. So I think without exception, we can go after getting funding. And then if you found a different source of funding to essentially refinance or pay off the initial source, we could. And frankly, that's what we're doing here. So people that get their first tranche, let's take Lamy's client for over the weekend. And I can't remember what the client's name was. Probably shouldn't say it anyway on this recording. But Lamy had a client that got his first tranche, and Lamy, I forget what it was. I think it was 25,000. That's approximately right. So that was the first tranche. Then we'll move forward. We'll build the loan package out, go get the larger amount, the second tranche, and we'll pay the first tranche off. So the same can be said that we can get an initial round of funding in the second tranche, but then we could refinance it with maybe a traditional loan if desired. So that is a good point. So Darius, let me know if I didn't answer your questions on the collateral. Yes, quite a bit of interest in the OBD, bouncing back to that, but that's not really our topic today. Selena asks, so basically it's about 2 weeks for the first tranche funding. Yeah, that's about right. So from the time that you get the client under contract and collect the performance fee, whatever amount you want, then you alert us that you have a client, you share with us our portion of the processing fee. Normally in about 7 days, we can get the shelf corp delivered. And literally on the same email that we're delivering the shelf corp deliverables, we're going into funding. And so then they'll get their offers typically that same day. And then for most of those lenders, they can get funded within just a couple days. So I'm given a 3-day window there. So yeah, so normally from time of enrollment to first tranche should normally be less than 2 weeks. All right. Yeah, so what we do, Darius has got more questions about the AR. So what happens is when we're building the loan package out, we work with the clients to put together what's called a PFS, a personal financial statement. We've had separate trainings on that, and that's where we can identify what collateral they're bringing to the table, if there's a shortfall, and then we can work with them to provide that. But that's really more of an individual uh, case by case scenario we need to work with the client on. So any client you have, Darius, or anyone else, will take them through the process. And in this in the second phase, so let's go ahead and clarify that. So we have two phases, which is different than tranches. Phase one is getting them their shelf court, and that's normally 7 days, right? We've discussed that many times. And then phase two is the funding prep, funding phase. And so this is where we build the loan package. So the loan package is built in phase two. And so that's what allows us to get the larger amounts because we have the greater documentation. This is where we do the PFS as well, is in phase two. Phase one, other than the client just signing the agreement with you and paying you the processing fee, we're taking care of the rest. They are involved in phase two. And part of this is identifying the uses of funds. What do they want the money for? I probably shouldn't say this, but I will. I have a client, he was mad at me on yesterday, Sunday. So he received his shelf court, which is great. Wasn't mad about that. And then we were ready to go into the phase two, which he did. And so with that, then we have a form that we send out to everyone to ask for, okay, how much money do you need and what are you going to use it for? So we have an understanding because that makes a difference. He was mad as a hornet that we asked him what he wanted to use the money for. He would, and I don't want to say he was naive or financially illiterate, but in his mindset, he didn't have to tell anyone. He just wants $1 million or whatever the amount was. He doesn't have to give anyone an explanation. Well, that's too good to be true, right? There's lenders that's loaning the money. They want to know what it's going to be used for. So there certainly is client involvement in phase two because it's the client that's the CEO of their business. They know what they want the money for. We don't. And so we have to ask them. So hopefully no one else will be offended by that simple question. Mark's asking about the Opportunity Fund. Yep. So Mark, you can go to 509 Pacific, which is listed here, 509pacific.org. And then on the website, there's information about becoming a reseller or a branch office, whichever you would want. All right, and if anyone needs individual assistance, best thing to do is send us a text. We'll be back tomorrow morning. Our recordings are put up on our YouTube channel. Thanks for joining us. Hopefully you have a better understanding of how private credit might provide funding for some or many of your clients that need either more flexible terms, easier access, faster funding, or could benefit from fewer disclosures and oversight. So everyone back tomorrow morning. Have a great day. Bye-bye.